Hey everyone, it's Robert Steim, Keller Williams Realty, the Marketplace, Steim Realty Network, your favorite realtor in Las Vegas. Hey, I was actually talking to a client the other day and we were going over the amortization schedule and, we were just talking about how nobody ever explains this and some ways you can kind of play with the numbers and just kind of understand how your payments work when you're paying off your mortgage and how much money's going to interest, how much is going to the principal balance. So I wanted to do a quick video that kind of gets a little bit nerdy, but hey, that's me, right? Numbers and stuff that we can do to kind of improve our wealth building opportunities and just how little changes can make a pretty big difference with this sort of thing. So anyways, I wanted to run a scenario. So we're going to use a $400,000 loan amount. So let's just say $500,000 house, put $100,000 down. You're going to be left with a $400,000 loan amount. Do that for 30 years. Interest rates, we're just going to ballpark at 6.5%. And we're going to say that we bought the property today. So don't take any of this, interest rates can vary. Everybody's situation is different, all that fun stuff. This is just for illustration purposes and just an example. But in this scenario, your monthly payment's about $2,500 a month. And these calculators will usually just show you the principal and the interest. So it's not going to show you what your taxes, property taxes on the property are going to be. It's not going to show you what any insurance on the property is going to be. Those are usually factored in your total payment. This one's going to show you your principal and interest, and then there might be a homeowners association associated with the property. That's usually paid separately. But anyways, just kind of understanding this $2,500 doesn't cover your entire payment, but just the loan portion of it. So in this example, the person's going to pay $510,000 in interest. So you take that 510, add it to the 400. That's where they come up with the 910 for the total cost of the loan. And that number always looks scary. And I don't know, for some people it makes you question, is it really worth buying a house when you're going to spend $500,000 or $400,000 on it, and then you're going to end up paying that much? But I'm going to show you why that's a big deal. And home ownership's really the way to build wealth, and investing in real estate if you want to take it the next step. So anyways, this chart was kind of interesting anyway. So it kind of shows you with the different lines here. So this dark blue one is the loan balance. So you can see over the course of 30 years, the loan balance is going to slowly get down. And you're going to eventually pay that off 30 years later or sooner if you play the game a different way. And you can also see that it's kind of a slow pay down, and then it starts to accelerate and go down a little bit faster. So I'll kind of show you some key numbers with that. And then as you're making payments, obviously you're paying more and more interest all the time. So the green line is your interest paid, and your loan balance, we already talked about that. So principal paid is the light blue. So this is how you're paying off your principal. So this will get to 400, you'll be paid off. This goes to 0, you'll be paid off. But one of the things I've always thought was interesting, so if you look at $400,000 loan amount, what does it take to get you to $200,000, the halfway point? So this one, roughly 2044 or 2023, so 21 years. It's a 30-year mortgage, and you would kind of think 15 years into it, you'd be halfway paid through, but that's not the case. The way the interest is calculated and applied, it takes about 21 years for you to get to the halfway point, and then it's more accelerated from there. So what I found is if there's a way that you can pay this off a little bit faster and accelerate this, then long term you tend to have more equity built up, build wealth a little bit faster. And this does not take into account any appreciation of the home. So over the course of 30 years, if the value goes up, obviously that creates equity for you. You also gain equity by paying down the balance, and now you're kind of almost putting money in a bank, but your house is the bank in this case, and you can access it down the road if you want to. But anyways, I thought this chart was kind of cool. Just showed you that part right there, but getting into the details a little bit more. So let's just look at your first few payments here. So this is the part that everyone kind of jokes at when they're at the closing table, they're signing, they get this handed over to them. So they either look at it or they don't. If they do look at it, they're like, oh man, I'm making a $2,500 payment. $361 is going to the principal. The rest is going to interest. So you see that balance over here, 399.6, 399.2, 398.9. It's only going down a few $100s every month. So it just feels like a long road. I mean, you're not going to hang this on your fridge and check off every payment that you make and watch this slowly go. But over time, you know, you have to pay rent anyways. You might as well pay a mortgage and at least recoup some of this. If your rent's $2,500 and your mortgage payment's $2,500, you can look at this as, hey, you're at least depositing $360 every month into your account, your home equity. But you also see every payment, the principal amount gets a little bit higher, a little bit higher, a little bit higher. And the interest side of things, it gets a little bit lower, a little bit lower. So let's take a look. So 2023, let's go to 2033 and just see what that looks like. So now, instead of 361 going to principal, we're up to 676 going towards principal. So we're definitely making progress. More money's going towards the principal of the loan. You're gaining equity a little bit faster as a result of principal payment. And then your interest, the amount is going down from down to 1851 from 2166. So the same $2,500, it's just going to different places. And over the course of those 10 years, you can see you've pretty much gained about $60,000 in equity based on paying the mortgage balance down, and then take into account if there was appreciation for the value of the home. Typically, historically, we use 4% going up every year. You know, there's going to be good years, there's going to be bad years, but typically 4% over the history of home ownership is pretty accurate. So 4% of 400,000 would be 416 after 1 year, but we won't talk about that right now. Let's just focus on the amortization thing. So now let's go forward another 10 years. So we'll go to 2043. And to me, this is, I don't know, this is kind of a fun milestone. You get to the point where more money is going towards the principal than it's going towards interest. And then you look over here. So now we started at 400,000. Now we've got $175,000 in equity from paying down the balance. Money you wouldn't have if you were renting. So I don't know. I think real estate's just a tough thing to beat when it comes to building wealth over time and money that you would be spending anyways in most cases. But also pay attention here, the 126.5, 125.2. So we're dropping in these big chunks. So this number is now accelerated and going down faster. So if we go back to that chart, that's where you see, you know, you're kind of hitting this curve and you're starting to go down faster. So that was right about this year 21. We were 20 years in the future, and you just see it goes down a lot faster then. One thing a lot of people don't think about, and some people aren't able to, and that's totally fine, but if you could, and early in the process, especially if you had some extra money that you could put towards the purchase of your home or put towards additional payments, you can really see this number accelerate. So let's just say you had an extra $1,000, $1,100 and you wanted to put it down on the property, or even let's just say $400. So $400, got an extra $400. I'm making my normal payments, have an extra $400, and I decide to put it on my mortgage. So that payment, in most cases, most banks will credit it towards your principal, your remaining balance. So take $400 off, you basically drop down to here. So it's more significant than that though, because if you drop from here to here, you really just kind of eliminated this entire payment. So even though you put, let's say in this case, $365, $366 on top of your normal payment towards the principal, then you just basically eliminated this interest payment. So you kind of turned $400 into $2,600. Does that make sense? Do it again, or drop $1,000 or $1,100, and now you've wiped out this payment, and this payment, because you jumped from here to there. So you can see how you can get to the finish line faster. You can save yourself some money on interest as a result. And just something most people don't think about. Most people want to just make their minimum payment. They know they're going to be in it for 30 years. This also doesn't apply as much if you move around constantly, but from a real estate investing standpoint, or If you buy a house that you plan on staying, someday this principal and interest goes away. You pay it all off, and now you're just stuck with the taxes and insurance. But that's a pretty big chunk of money that now you don't have to pay to live your life every day. Or if you buy an investment property and you hold it long term, and this is all being paid off by the tenant, you're just creating wealth along the way. So you're gaining appreciation from the value of the home going up, paying down the principal of the home. So it just works for you in so many different ways, and understanding how this works maybe just helps you manage your money or think about what you want to do. There's of course the argument that having too much equity in your home isn't as beneficial as it could be. You could be using that money to buy another property and then another property and compound this whole process. Everybody's kind of got their own different goals and different ways of thinking about it. So I certainly don't just give generic advice depending on what everybody's, maybe your age or maybe what your goals and when you want to retire and how hard you want to push or how much risk you're willing to take. Those are all things that go into the idea of this. But even if it's just your primary home, that's all you ever own, this beats renting most of the time. You're putting money into your future. You're paying your bills down so that someday maybe you can live mortgage free and you could have a nice nest egg built up in your house. So anyways, this all comes from bankrate.com. It's just the calculator that I tend to use sometimes. They have an amortization schedule. You can go there and play around for yourself, change these numbers. Market conditions will change, but you can change this however you'd like. You can even go back in time. If you bought a house 5 years ago, you can throw in the amount of your loan, 30 years, whatever your interest rate is, backdate this, and you can see the breakdown of what principal and interest are currently and compare that to your current bank statement. Or if you have paid in advance, then you can do the same thing and see what your current breakdown should be versus what it actually is. If you made some payments in advance, you would see that you might have fast forwarded yourself 2 or 3 years just by making a couple extra $1,000 payments per year. Some people do one extra payment per year. Some people do a couple $100 here and there. Whatever strategy works for you, but this does accelerate things. So anyways, thanks for nerding out with me on this stuff. And if you have any questions, drop comments below, or any other topics that are of interest to you. I'm happy to get into that stuff. And go ahead and like, subscribe, drop comments, all that fun stuff. Help me out with that. And we'll see you next time. Thanks.